Perfect.
Yeah. Anybody waiting?
What, you want us to wait?
There you go.
We should have a couple more. Mr. May, did you send your friend the invite as well?
Oh, he's on mute.
Oh, there's our, okay. She's connecting to audio. Okay. Okay, she's on. She's just not doing. Should we wait or start?
We might as well get started.
Yeah, is that all right?
Perfect. Great. Well, thanks everybody for coming out tonight and still sitting in the comfort of your own homes. We're going to actually, for those that don't know me, my name is Paul, and I'm a broker with Remax. And to my right over here we have Mary Ross, who's also a broker with Remax, and to my left we have Michael Brooks, who's a mortgage broker with Momentum Mortgage. So just a little bit of background. So Michael has been a mortgage broker for 14 years. And is extremely knowledgeable with the mortgage industry and the ins and outs of financing, lending, different products like that. And I'll definitely let Michael get into a little bit more detail on that. Mary, who actually got me into the real estate business, has been doing real estate for 20 years. So she's again very knowledgeable with the real estate side of things. Myself, I'm the new guy here. I've only been in real estate for 5 years, but prior to that, I spent almost 20 years in the financial services industry as well. So which has allowed me to bring a good deal of wealth over to help my clients on the real estate side. So I'm going to let Mary ask Michael the first question. We're going to let Michael do most of the talking.
Hey guys.
Will we have do you want people to interrupt with questions?
Yeah.
Or do you want to hold questions till the end?
They can feel free to ask
Okay.
questions.
Sure, yeah.
So if you have a question, maybe just raise your hand and we can raise your hand and we'll answer them as we go. So Michael, can you thanks. So Michael, can you explain the difference between just going to your bank to get your mortgage or going to a mortgage broker? Before I got into the business, I had no idea what the difference was. So if you could help us, that would be awesome.
Sure, that's a good question, right? So when you go to your own bank to secure mortgage financing, your own bank is only going to be able to offer you their own suite of products. So let's use, for example, TD Bank. If you walk into TD Bank, they're only going to be able to offer you what TD Bank offers at that day, their fixed rate, their variable rate, whatever. But let's just say RBC down the road or CIBC has a much better program on. Do you think your TD rep is going to say, hey, you know what, don't go here, go down the street and go to the other bank? No, they're only going to offer you what they offer you. So you're very limited in your options. Whereas a broker like myself, I can get you a mortgage from almost every bank, credit union, trust company, private lender in the country. So you would come to me and you would say, Michael, where is the best deal for my situation? And then I would do the shopping for you and I would source the mortgage from whichever bank or company is going to give you the best deal. So that's the benefit of using a broker.
Is there a fee for that, Michael?
99% of the deals, no.
Awesome.
But in specific situations, like with a private mortgage maybe, or things like that, there would be a small fee, yes.
So for normal
mortgages, no,
people?
there is no cost.
Great, that's awesome. Thank you. Can you help us understand a little bit about terms and meanings? For example, what does it mean if you want to go in firm, like we had this crazy market over the last few years? So what does actually firm mean from a lender perspective?
So when you're purchasing a property and you put your offer to purchase forward through your realtor, sometimes you can have conditions in that offer. And that allows you as the buyer to do your own due diligence and ensure that the property is what you want to buy. It gives you an out in case something is not up to par. So a home inspection clause might give you the opportunity to get a home inspection on the house, make sure everything is good to go before you decide, yes, I want to put my name to that offer. So firm up on the offer. So that would be a home inspection condition. When it comes to financing, you may want to put a condition in just because sometimes there may be need for an appraisal on the house. Sometimes you may be in a unique situation where you're self-employed and we need to do a little more due diligence on your employment income with the banks. And there's various other situations where maybe it's going to take a couple of days just for the banks to firm up and finalize your financing by reviewing all of your documentation. So that being said, if you put a condition of financing and it just gives you enough time to get 100% certain that your financing is all ready to go and all of your documentation has been looked at. If you go in firm on your offer to purchase, that means there's no conditions whatsoever. So you have no way to back out if you go in after and you find out there's a problem with the house and you should have done a home inspection. Sorry, but you went in firm. If you go in with no financing clause and the bank says we need to do an appraisal and the appraisal comes in and the value is low, or there's something on the appraisal that stands out and the bank decides they don't like the property, now you have no out because you didn't have a financing clause in there. So going in firm just means that it's a little more risky and you're putting yourself in a sticky situation if anything goes sideways at all.
Thanks, Michael.
Marion put something on the screen there.
Oh. How do I do
Oh,
it?
sure.
Yeah.
Actually, I can do this.
Can you talk about vendor take back financing? Okay.
Sure.
Okay.
So a vendor take back is a fancy way of saying that the seller of the property is going to hold a portion of the value of that property as a private mortgage to the buyer. So if the buyer comes and they say, I have a portion secured as my mortgage financing, I have a portion as my down payment, but together that's not enough to purchase the property, would you mortgage the balance back to me as a private mortgage? That's what a vendor take back is. So a vendor take back is the seller mortgaging a portion of the sale back to the buyer as a private mortgage. So it would be secured against the property and it would have an interest rate and a payment and discharge fees and things like that, all secured and registered through the lawyers, but it's essentially a private mortgage. Does that make sense?
And would that mortgage come in second to the first mortgage?
Yes.
Okay,
Most cases it
Okay.
would.
awesome. Great. Thanks, Marion.
So,
Oh, we have another question.
oh, yeah,
Oh.
Gavin has a question.
Thank you. I'll lower my hand. There we go. You were talking a few minutes ago about needing an appraisal, but if your bank has pre-approved you for a certain amount, couldn't you, can you not just say, okay, I'm pre-approved for, in this market, 800,000, and you make an offer for 700 firm, is it still, your bank may still say no based because they want to still do an appraisal? Even though you're approved, you're not really approved. Is that
Correct. So that's a good point. So I'll address a couple of things in that. So when you get a pre-approval from a bank versus a broker like myself, a bank pre-approval is never guaranteed financing. And I say that because a bank pre-approval is just a piece of paper spit out by the guy at the bank who just asked you a few questions and put it into the system. If the numbers work, yep, you're pre-approved. They don't actually underwrite all of your documentation and everything else. So they have a branch person and then they have an underwriting center, usually down in the city. And the underwriting center is where they actually do all the final underwriting of the file to give you a secure financing arrangement. But they never do underwriting of pre-approvals. So if you take that pre-approval from the bank, go to get your financing, and then submit all your documentation, and the guy at the underwriting center doesn't like some of your documents, he can still decline you. And that happens a lot, where you'll have a pre-approval in hand, and you'll go back to get your financing when you put an offer in, and they say, sorry, we're not going to give that to you, because their pre-approvals are basically useless. So
Great.
if you come to a broker like myself, it might be a little more hassle up front, because we're going to ask for a lot of your documentation up front. But that way, we've already underwritten the deal. We know exactly your situation. We've done your credit checks. We've checked over your income documents, your down payment sources, everything else. And we know that you're going to get whatever the mortgage is we've pre-approved you for. And on top of that, you're confident that you can get that mortgage because everything's already been reviewed. So that's the one thing I wanted to address about the pre-approval. But the second thing was about the appraisals, because that was a good question. When you're pre-approved for a mortgage, that's just that you as the client are pre-approved to secure that amount of financing. But the second piece of the puzzle when it comes to putting an offer on a purchase is the house. And when you're pre-approved, you don't have a house yet to buy. It's just you're trying to get arranged for financing. Once you add the house into the mix, the bank has to not only approve you for the financing, they have to prove that they're going to put that financing on that house. And so if they do their appraisal and they don't like that property, they're not going to give you the mortgage for that property. So the appraisal is vital. And so if you have a firm offer with no conditions and the bank does order an appraisal, and the appraisal, like I said, comes back, maybe the value is low, or maybe there's something in the house that they don't like if it's a century home and they don't like doing century homes or something, they can still decline to finance that property, even though you have a pre-approval. So if you're in a firm offer situation, that'll be sticky.
Okay.
Would
sorry,
that
if
be
I
the
can-
same? Would that be the same with a broker? Would the broker do that to you?
Well, yeah, that's what I'm saying. It's not the broker that's doing it. It's the
No. You said the bank, and you explained the bank business. But how about a broker like yourself? Okay, let's say we pre-approved.
Yep.
And then all of a sudden, the price of the house is 100,000 more than what you approved. Would you go back and maybe look at the financing and everything again and say, yeah, okay, we can approve that, or would you say, no, you're done?
Well, how a pre-approval works when you come to myself or the bank, we give you a maximum budget. So if you go out and buy a house that's over that maximum budget, there's nothing I can do. I told you what your maximum budget is and you went above it. So if you buy a house that's 100,000 more than your pre-approval, and then you come back to me and say, hey, can you approve this now? Likely no. Likely you bought too high. You're supposed to buy within the budget we give you, and then everything should work out fine.
Okay, because what I'm looking at is that what happened in our neighborhood here is that there was bidding happening, and some of the houses around here just topped out as far as I was concerned. It was nuts what people paid for houses in this area. But
yeah, you're right. It is nuts. And so what's happened is in those situations, the buyers that are bidding over and over and over asking price and bidding it way up and spending hundreds of thousands over the asking price, they still have to only be bidding within their budget. So if their budget was 800,000 and they had a house that was 600,000, and then they're trying to bid it up to 650, 700, 750, 800, and then they go 900, 950. Now they're above their budget and they're bidding too high. And if they secure that house and they've bid too high, they're very likely not going to get that mortgage because they bid above their budget. So what's happening when they're bidding up those houses is they're usually shopping below their budget and then bidding up to what they can afford.
If I can jump in for another follow, if you don't mind.
Yeah.
So if I came to you as a mortgage broker and you sat down with me and went through all my paperwork and you said, yes, you're pre-approved to X, So that's my budget.
Yep.
As long as I don't go over X, regardless of whether I wind up paying more than the house is worth, you'll still give me the mortgage. So if you give me a budget of $1 million,
Yeah,
and I find a house, I could put in an offer, a firm offer for 800, I'm below budget.
yeah.
But actually fair market value is only 500.
Oh.
All right. So that's another good question. And this is where it starts to get complicated. These are good questions. I'm glad you're asking them because this is the market we live in right now. But they're complicated questions because so this is why I said there's always two pieces to the puzzle. There's your pre-approval, but then there's also the house. And so your pre-approval may be for 800,000. You bought the house for 800,000, but it's only worth 500, right? So on one side, you have your pre-approval. Yes, you're pre-approved for that amount of financing. But then when it comes to the bank putting that financing on that house, and they appraise that house and it's only worth 500,000, in the mortgage world, there's a term we call loan to value, LTV. You'll hear that thrown around a lot, the loan to value. So the banks can only lend you a maximum percent in Canada of the value of the home. They can't lend 100% of the value. They're not allowed to. In Canada, it used to be that they could only lend 95% and you had to put in at least 5% or more. So let's use that scenario, 5% down payment. So if you bought a house for 800,000, but then the bank appraises it and it's only valued at 500,000. The law says, and it's the law, it's not the bank's rule, it's the law. The law says in Canada that the bank can only lend you a maximum of 95% of the value of the home, not what you bought it at, but the value. So if it's valued at 500, they're only going to lend you 95% of 500. Uh-oh, you bought at 800,000, so you're only going to get a mortgage of 95% of 500. All that difference now becomes your responsibility as a bigger down payment. So that's how it works when you bid over the value of a house.
Regardless of whether it go through a bank or go through a mortgage broker.
Regardless, because it's the law. It's not a broker rule, a bank rule, it's the law. The law says the maximum that a bank can lend on is the percentage of the value of the home.
Okay, all right. Sorry to get you off script. Go ahead.
Does that make sense? Does that help clarify it a bit?
No, it does for me. Yeah, thank you.
Good.
Thank you, Gavin. Okay, we'll move on to our next question, everybody.
Right. Yeah. So as we've no doubt seen pretty much probably right across the country, real estate prices have gone through the roof the last 2 or 3 years. And obviously first-time homebuyers, I'm sure, are feeling the crunch when they're trying to buy the house. So how can parents help their kids or grandkids secure a down payment and maybe still have some security for themselves with the money, being able to get the money back?
For sure. Okay. So a lot of parents are pitching in these days because the prices are so high that the kids don't have a big enough down payment. So we're seeing a lot of parents gifting a down payment to the kids to help them secure the mortgage. And there's a few ways they can do it. So one is if they just have assets, if they just have cash or investments, they can just literally gift it to the kids. The kids get them to sign a gift letter that goes to the bank with their mortgage application, and it's approved as a gifted down payment from family. The other one is if the parents don't physically have cash investments, but maybe they have equity in their home. So they could take out a mortgage on their home if there's room to do that, and then just gift the money that way to the kids. Or sometimes the parents will have a line of credit on their house already. They may have paid off their house, but they have a line of credit. So they'll just write a check off the line of credit and give that to the kids. Now, it gets a little complicated because shouldn't say you're not allowed, but it's more difficult to qualify if you're claiming it's a borrowed down payment. So if your parents say to you, we're lending you this money, we want it back. It's not a gift. There are specific rules where you're allowed to qualify with a borrowed down payment, but it becomes more complicated and more difficult because now we have to account for the liability of that debt payment back to the parents. So it's easier and better if it's a gift. It can be done if it's lent, but it's not ideal. So I have had parents say, well, I do want the money back, right? Okay, that's kind of borderline because technically to qualify, it's supposed to be a gift, which means you're not getting it back. But we all know that over time, it's likely the kids are going to be paying down that mortgage. The house price is going to be going up. There will be equity gaining there. And there's a chance down the road that the kids could refinance that mortgage, pull equity out and pay the parents back. And I have done that recently. There's actually three right now, sets of kids that bought in 2020 and 2019. And all three of them right now are refinancing to pull equity out to pay those parents back the gifted funds that they had given them originally. So,
Michael, can I ask you a question?
Yep.
So if I gifted my kid some money
Yep.
with their spouse, and all of a sudden 2 years from now that marriage isn't successful,
Yep.
how would I protect myself that the spouse isn't taking half of the gift I gave them?
So that's a very valid point. It's a good question. It's a little bit more of a legal question
Okay.
than a mortgage question, because I think when you're splitting the assets of the house, if you gave the gift to your child, they're probably entitled to that equity plus the difference of the split.
Okay.
I don't think the other spouse would be able to get it. I've seen instances where the lawyers have
Right.
gotten the child that was gifted the equity to keep the equity from that,
Okay.
but it's a bit of a legal question.
If I went on title as well, would I have to pay capital gain when they sell the property on my share of it?
You shouldn't have to, because if it's only your second home,
Yeah.
and you went on title with your child, it should be, according to the law in Canada, considered a second home, not a rental property or an investment property.
Awesome.
So if you're going on title with a child, so let's even just say not to the marriage thing, but if you're just going on title with a child who's going to university and you buy them a property to live in while they're at school or whatever, and you're on title jointly, that's called a second owner occupied home.
Okay.
It's not a rental property or an investment property. So therefore it should fall under the owner occupied rules for capital gains.
Awesome. Thank you.
Make sense?
Perfect. Okay. Next question.
Oh, does Mary
Oh.
have a question?
Oh.
Yeah.
I don't know.
Oh, she had her hand up, so I'm not sure if.
Yeah.
Marion, do you have a question there? Okay. Next question. Although we've seen significant increases in real estate values, how does the cost of carrying a mortgage compare to pre-pandemic costs, affordability versus and interest rates? So compare before COVID and now.
Sure.
Thank
All
you.
right.
Yeah.
So you all know that in around 2019, 2020-ish, the rates were very low. Fixed rates were in the low to mid twos, and variable rates were below 2%. So with the increase in rates, right now we're seeing fixed rates with the banks somewhere around 5%, give or take. And variable rates are around 2.7-ish to 3%. So high twos to low threes. So with the increase in the house prices and the increase in rates, it has cut the affordability down. But here's the thing. To qualify for those mortgages, there was a thing that was brought in 2016, the government called the stress test. You may have heard that term thrown around in the news a lot. If you're not familiar with it, the stress test says, in the mathematical calculation that we use to determine the affordability of the mortgage, part of that calculation includes the principal and interest of the mortgage as a number we plug into the math formula. It used to be the principal and interest payment you would use was based on the actual principal and interest you'd be paying at the rate you're getting. So if it's a 2% mortgage, you would figure out what that principal and interest payment is, and you'd plug that into the formula. That spits out a ratio, and that tells us how much you can afford. What the government did is they said, okay, we're going to change that now. And in 2016, they said, we don't care if you're getting a 2% rate. We're going to make you qualify as if your rate is much higher, so that we're protecting you from interest rate hikes down the road. And for the last 2 or 3 years, that interest rate has been 5.25% to 5.5%. That's the rate you're qualifying at. So even if you get a lower interest rate on your mortgage, you're qualifying at a much higher rate. So what I would say is, even with the increase in house prices and the increase in rates, the stress test and the rate people are qualifying at still hasn't changed. So overall affordability has not changed dramatically. It has slightly because the house prices have increased. So what I would say more importantly is the down payment amount has increased. And what's happened is the rule with the minimum down payment in Canada, which is what we would say is first-time homebuyer rule, is that in order to put the minimum down payment, it's a calculated number, but I'll just simplify it and just say to put 5% down payment, which is the minimum you're allowed in Canada. You can only do that if the price of the house you're buying is less than $1 million. So $999,999. If you buy a house that's less than $1 million and you qualify, you're allowed to put the minimum down payment, 5%. As soon as you buy over $1 million, that rule of being able to put minimum down payment down is out the door. You're not allowed to do that anymore because it's a completely different set of rules. And so now you buy a house that's over $1 million, you automatically have to, by law, put at least 20% down payment or more. So on a house that's just under $1 million, you would have to put $50,000 down payment minimum. As soon as you go over that, now you have to put $200,000 down. So it's a big gap. And the problem we're seeing is that the majority of houses now are creeping over that $1 million range. So for a first-time home buyer to buy a detached home, you're probably a little over $1 million, maybe $1.1 million, and now you're having to put down that big 20% down payment. That's the biggest difference we're seeing. Not so much in the affordability of the mortgage, but now you have to jump into that second bracket and put the bigger down payment down. Does that make sense?
Awesome, thank
Thanks,
you.
Mike. Yeah, thanks, Michael. So from a lender perspective, what are some of the bigger concerns that lenders would have when they're looking at financing, both from the borrower's credit worthiness, but also from the property perspective as well? I know you talked a little bit about appraisals, so yeah.
Sure. So I'll break it down into those two categories again. One is the minimum down payment category, so under $1 million minimum down payment. To qualify in that category, you have to have really, really spotless, clean credit. So nice high credit score, good, strong credit history, and good, strong, stable income. So they want to see long tenure at your job, stable income, so salary or good tier average of hourly income, and they want to see really, really good credit. If you have bruised credit or bad credit, or you have a seasonal type job or things like that, that's where it's going to get a little more tricky in the minimum down payment category. Okay. But then when it comes to the 20% down payment category, which we would call conventional mortgages versus high ratio mortgages, which is the minimum down payment. So there's two terms to listen for. High ratio is the minimum down payment category. Conventional is the bigger down payment category. When it comes to conventional mortgage financing, the rules are a lot more open. So there's some banks out there that can give conventional financing to people with bruised credit, to people with various types of income like self-employed, seasonal. things like that. So it opens it up a bit more, but you have to have that bigger down payment. So that's the problem. So that's when it comes to the borrowers, what they may be looking for in the different types of qualification. As far as a property goes, again, I'll break it into two categories for now to keep it simple. There's a lot more than that, but let's just say the one category we call the A lenders, and the other category we call the B lenders. So your A lenders are your major banks, your credit unions, and things like that. They like those AAA clients. They like the really good credit, really good jobs, good down payments. They don't like anything fishy, right? So if you're looking to be approved in that category, then when it comes to the properties that they will lend on, they also want really good, clean properties. So they don't want really rural properties that have lots of acreage, that maybe have farming next to them, that have weird zonings, that have oil tanks in them, or just stuff like that, or stone foundations, or century homes. They really like your AAA, good quality, easily sellable properties, because they kind of match properties and clients. They like their AAA clients, they like their AAA properties, okay? When it comes to properties that do have some of those interesting characteristics, I'll say, so stone foundations or century homes or well and septic or rural properties with acreage, things like that, then you're gonna have to look more at some of the alternative or the B class lenders who have a little more open and flexible guidelines. So there are still banks that will do those types of properties, but then their rates are going to be higher than the traditional bank rates because they're taking a bigger risk on a property that's not as marketable. Does that make sense?
Mhm.
So when you're a AAA client looking to get the best mortgage possible, then you're also gonna have to look for a pretty decent house. So a tear down or a house that's got a lot of mold in it, or it's a fixer upper, let's say, or things like that, that's not gonna go so well with the major banks.
Terrific.
Awesome. Great, thank you. Can you, I have a lot of clients that think because they have a huge amount of equity in their home, they can just bridge finance if the days, if the closing dates don't line up,
Mhm.
or maybe if their house hasn't sold.
Mhm.
And maybe they're selling a bigger house and they're buying a smaller, they're right sizing or downsizing.
Yep.
Maybe they don't need a mortgage on the new house. Can you explain what bridge financing is and who can do that?
Yeah, for sure. So bridge financing essentially is when you're selling one property and you're buying another one, and the down payment, or in some cases, the full cost of the purchase for the new house you're buying is all wrapped up in the house you're selling. So if the dates line up and the house sells on the same day the purchase goes through, you don't need any bridge financing because the lawyer just transfers equity from one house to the next. But if the house you're buying closes before the house you're selling, and all of the money to buy this house is coming from the house you're selling, where are you getting the money to close out the purchase if the sale hasn't happened yet? Because the money's wrapped up in the house, right? There's no cash. That's when bridge financing comes in. And bridge financing is a loan by the bank secured against the house you're selling for the money you need to close on your purchase. And in some certain circumstances where the house is worth enough money, it could be for the full amount of the property you're buying. In other cases, the house you're buying, you would have already secured a portion of it with a mortgage, but the down payment for the balance of that money was supposed to come from the sale of your house, which hasn't happened yet. So the bridge loan would be just for the down payment money. And so again, the bridge loan plus the new mortgage on the purchase property combined equals the whole purchase price, but the bridge loan is secured against the sale property, which is where your down payment is supposed to come from, so that when that house does sell, the bridge loan just gets paid back to the bank. They're just giving you the money until your other house sells.
what if the house your current house hasn't sold yet? It's still listed
Yeah.
for sale when your new property closes.
So again, good valid point, because it's happening right now these days. So a bridge loan through the banks can only be arranged if you already have a firm sale agreement on your house you're selling. It's just that the dates don't line up. If you purchase a house and you have not sold your other house yet, and you still need a bridge, then you will have to revert to a private lender, not a bank, not a credit union, not a trust company, because they won't do that. It'll be a private lender, which we have access to, and they will provide the bridge financing in hopes that your house sells. They're taking a lot bigger risk because your house hasn't sold yet, but that's because the private lenders will also charge higher interest rates. That's why the banks will not lend a bridge on a house that's not sold, because they don't want to take that risk if it doesn't sell. And they just won't. They won't take those risks. So unless it's sold firm, they will not bridge that house. So that's a risk you have to take right there.
Perfect.
Yes.
Yeah.
What kind of percentage difference would there be in the interest rate? So if the standard bank, ultimately, when you get your mortgage, it's going to be 5%, but you have to go to a private lender because you haven't sold your house yet.
Yep.
To fund the purchase you're making. What kind of, like, are we talking 1%, 2%? Like, how much higher is it going to be? Like 20%?
It's going to be all, yeah, not 20%, no, but it's going to be close to double what the banks are. So the banks might be 5% on a bridge, 6%. The private will be around 10%. Okay.
Oh, okay.
So it'll be about 10%. And the other thing is that there will be setup charges that the lender and the broker charge to do the private mortgage. So usually on a bridge loan, that would be anywhere from, let's say, 2 to 4% of the mortgage you're getting. Okay. So you're getting 100,000, that could be $4,000 in setup fees. Okay, just as an example. So that eats away of your profit when you sell.
Thank you, Gavin.
Great.
Our next question.
Yeah. So as I'm sure everyone has heard in the news, and we've been talking about it tonight, we've been seeing interest rates rising throughout the course of the year so far, and chances are, based on what the Bank of Canada is saying, interest rates are probably going to continue to rise for at least this part of the year. So from a purchasing perspective, should homeowners consider renewing their mortgage earlier, or wait till the term runs out, or what's the best option for homeowners right now with the rising interest rate, regardless of whether they're selling?
Yeah, for sure. So if you're just talking mortgages, not buying and selling, and you're talking about rising interest rates, what do I do with my mortgage now, etc. If you're on a fixed rate, I would hazard a guess that you probably got that 2 or 3 years ago, and your rates are probably in the 2s or 3s. If that's your case, I would stick it out. I would ride it out to the end of your term. I would not switch because the rates are a lot higher right now. So if that's you, I would ride it out to the end of your term, and then we'll see where we're at then. Okay? Because I don't think that these high rates are going to last more than 24 months. I think 18 to 24 months, this issue we're dealing with, inflation, the COVID pandemic, the war in Ukraine, these things, I think by 2 years from now, they will have resolved, and things will start to even back out. So I would say if you're on a fixed rate, that's a low rate right now, I would ride it out. I would not switch it. If you're on a variable rate, obviously you're feeling the pinch with the rising cost of the interest, the prime going up. I would really say it depends on what your discount is, because with a variable rate, the true rate is what your discount is off of prime. So you may have a prime minus 0.25%, or you may have a prime minus 1%. If you have a small discount, you're feeling the pinch a lot more than if you have a bigger discount. So in that case, there are still some decent discounts out there. If you have a small discount on your variable, I would definitely say you should come talk to me, because we could maybe drop that discount down to negate some of the future increases that are coming. Because if you have a prime minus 0.25 and they're going to raise it 0.75% coming up in July, if we dropped you down to a prime minus 1, essentially your rate's not going to change. Because with the 0.75% increase, you're still at basically what you were with the prime minus 25. So that's the kind of thing you would look at if you're on a variable, what your discount is, and then we would decide if it's worth it to break it. Because the other thing is with a variable rate mortgage, anytime in your entire term, you can break that mortgage with only 3 months of interest cost. Whereas if you're on a fixed rate mortgage and you want to break it early, you're going to end up with the bigger penalty that we call the IRD penalty, interest rate differential, and that could cost you tens of thousands of dollars. So it's probably not worth it. But if it's a variable and you have a small discount, I would say definitely talk to me and we'll see what options there are available.
Thanks, Michael. 2 more questions, everybody, until we open it up some more. So, Michael, I have a lot of buyers right now who are thinking of, who are sitting on the fence or thinking, do I sit on the fence? Housing, and their thought is housing prices are going to fall. So should I just wait until housing prices fall a little bit more? But then interest rates are going up. So what would your suggestion be to them?
I would personally say, if you can qualify, buy now. Because prices are on the way down, but rates are going up faster. And I think we worked it out before that the house prices would have to come down quite a bit to negate the interest rate hikes. I don't think the house prices are going to come down as much as they need to. So what I'm saying is you would have to wait for a long time for the house prices to come down in hopes that the increased rate on the lower house is as affordable as the lower rate you're going to get today on a bit higher priced house. I don't think they're going to equal it enough. I think the house prices are not going to crash enough to make it worth waiting.
Awesome. Thank you, Michael. And of course, he can answer that question on a one-on-one if you're in that situation.
Yeah,
right?
for sure. Absolutely.
Yeah.
Our last question, actually, one of our viewers sent this in, so ahead of time. So I'm going to pose this to you now.
Yep.
So, as a hypothetical perspective, let's say you've got cash or resources sitting in your bank account, TFSA or whatever, to pay off your mortgage right now. Is it worthwhile, knowing that interest rates are going up, to pay it off ahead, to pay it off now, assuming the penalty is not too big, or continue to let that sit in your bank account, knowing that house prices are dropping and interest rates are going up? But it's
Sure.
Yeah.
So that's a good question. It can be a complicated question with a long drawn out answer, but I'll try and simplify it. So my perspective is there's never a rush to pay off your own mortgage. End of story. If you have cash sitting around, don't throw it on your mortgage. Okay, there's way better things you can invest it in than your own house. Your own house is not an asset, okay, unless you sell it. But until that time, it's actually just a liability, because even with no mortgage, you still have maintenance, utilities, property taxes, everything else. It's a liability. It's not making you any money. It's costing you money, even with no mortgage. So why pay off your mortgage when you could take that same cash and put it into something way better? Whether that's a cashback life insurance policy, whether that's investments, whether that's an investment property, a rental property that's actually making you cash flow and paying for itself. There's just better things you could do with the money, in my opinion. I would never spend my personal money paying off my mortgage any faster than I need to. That's just my opinion.
How about if your mortgage is coming due?
Like if it's coming due for renewal,
Yes.
if you have, I would still say if it's coming due for renewal, just renew it for another term. Like I'm just saying, my opinion is I don't see why you would want to pay it off faster than you need to, because there's better ways to invest the money in things that can make you more money. And so by putting it into the mortgage, you're just losing out on what you could be making with the same money.
So are you saying, Michael, that the mortgage rate, percentage rate you're gonna pay would be less than what you should be getting if you invested it somewhere else?
The return, yeah.
The return,
Yeah, I would say you get a bigger return on your money in other things
Right.
than by putting it into your own mortgage.
The other thing, just to add to that as well, is just the liquidity factor as well. If you have the cash sitting in, mutual funds or a TFSA or something like that, you can generally get that money in a couple of days. If you put it all into real estate, a couple of years ago we could sell in a week, but at the same time, there's been times in history where it's taken a month or 2 or 3 or 4 months to sell that property. So it's definitely not a liquid asset.
Yeah.
Good point. Yeah, good point.
Perfect. So I think somebody typed a question here. Two questions.
Okay. If you're on title with your child's house, are you saying no capital gains? So that's the second owner.
Okay.
For people so that's the first question. Second question is, for people downsizing, if moved to house, where do you not need more, if you're downsizing and you move to a house where you don't need a mortgage, what options do you have other than breaking a mortgage?
So
Okay.
is that from Marion? Marion,
Yes.
I think I understand what you're saying, so I'll try and clarify it. You're saying if you have a mortgage on your current house, but you want to sell that house and move to a smaller house where you don't need a mortgage, what options do you have? Is that what your question is? The only option is to break that mortgage and pay it off. There is no other options. The only other option would be to not pay it off and port that mortgage over onto the new house and continue it on until it renews and then pay it off when there's no penalty. So you could do that, which might be the better option. You could port the existing mortgage you have over to the new property when you sell, and then just ride it out until its renewal date and then pay it off.
Right. Awesome. And I think our first question was, if you're putting yourself on title with one of your children, and then they go to sell it, is that a second owner occupied property and there shouldn't be capital gain?
There shouldn't be capital gains.
If it's your child is living,
Correct.
an immediate family member,
Correct.
and it's owner occupied, then you're allowed no capital gain for that.
Correct.
And it's just one property,
Should
one
be.
extra property.
Yeah.
Okay.
And now one thing also that your lawyers can do when you do go on title with a child to a house is they can register you as only a 1% owner,
Okay.
Right.
and the child or the children as 99% owners.
Okay.
So that also negates land transfer taxes and other things like that.
Right.
Right.
Awesome. Okay. Right. Do you want to explain that more? The land transfer tax? Is that because of the credit? Is that why you're saying it for
Well, with
land transfer tax?
a child, it wouldn't be land transfer tax, because to transfer between immediate family members, there's no tax anyways.
Okay.
But in a case of a non-family member
Okay.
and you're co-signing for them,
Right.
you could be registered on the title of the house as just a 1% owner,
Okay.
so that when that house does dispose or sell, the tax payable would be mostly to them,
Okay.
right?
Yeah.
Not much to you.
Okay. Awesome. Does that answer your question, Marianne? Oh, can you only do it for one other property? Can you do it if you had two children?
That's a good question. You are allowed to go on title with two children on two different houses. As far as which would be capital gains, then I think that would be a legal question for a lawyer, and maybe we can bring a lawyer on for our next webinar.
Right. Yes. Yeah.
So that's a very good question. Don't quote me because I could be wrong, because this is a legal question, not for me, but I believe that on another property, then there would be capital gains, because I would say you're only entitled to one owner occupied property and one second home. As soon as you add a third or a fourth or a fifth in there, you're going to pay the capital gains on those.
So Marion, one of our other
Yeah,
attendees
favorite
is
child
saying,
only.
pick your favorite child.
Yes.
Exactly. Yeah. Sorry for the other ones.
Yeah. Any other
Sure,
questions,
yeah.
guys? Sorry, any other questions? Anybody raised their hand if did you learn anything new? Awesome.
Great.
Okay.
Perfect.
Well, go ahead.
Yeah. No, I was
Yes,
just gonna say thanks. Oh, yeah.
Maybe I should be talking to, is it, who's sitting beside you there, Paul, to your left?
Oh, Michael. Yes. Yeah.
Mike. Maybe I should be talking to you, Mike.
Yeah.
Yeah.
Give me a call anytime.
What's your number, Michael?
Yes.
You
Then
can
I
write-
gotta get a pen.
Yeah, find a pen. You can write my number down.
Do we call you Mike or Michael?
I like Michael, but I'll take Mike. It's fine.
Okay, that's good. Phone number?
705-331-6153.
Okay.
Perfect.
Thanks. Right. Yeah. So, any other questions that we can answer while we're sitting here?
Well, if any of you know of somebody that needs some mortgage help or pondering a sale or a buy, by all means, our goal is just to provide information and guide you the right way. And over time, you'll do business with us. So if we treat it that way.
Perfect. That's great. Well, thanks for coming out, everybody. And yeah, like Mary mentioned, if you do know anybody, feel free to pass our names on. And I think that pretty much covers it.
Yeah, thank you very much, guys.
Thanks
It was very
very
nice to
much.
meet you, and hopefully we'll talk to you again soon.
Thank you,
Thank you guys
guys.
very much.
Thank you.
Thanks,
Take
guys.
care.
Have a
very
great
much.
evening.
Bye.
Bye-bye.
See you later.
Bye. How do I shut
Oh,
this off? Leave.